Get talking now, shall we? Mr. Abdulqudus Isiaka is a senior economist at ProShare, and he joins me on Business Week. Mr. Abdulqudus, thank you so much for agreeing to speak with us here on Business Week.
Thank you for having me.
Let's get started from the global perspective, as Russia's invasion of Ukraine has increased prices for virtually everything, from energy to wheat, adding to inflationary pressures affecting major economies all around the world, including the US, the UK, Germany, and France. It has been described as the highest level in decades across countries of the world. I wonder just how devastating is this particular situation?
I think you made a very salient point about the impact of the geopolitical tension in Ukraine on prices the world over. We could literally say at this moment that it's raining on every roof. Prices are rising. Crude oil prices soared to unprecedented levels, $100 per barrel. And, the same thing for wheat, the same for corn. And until, the last 2 months where we saw a moderation in global food index due to, increase in harvests, we've seen unprecedented levels of prices, also in terms of commodities. And, we all know what led to all of this. Russia has taken the decision, wrongly so, to invade Ukraine, and in doing that, it has incurred the wrath, in quote, of Western allied countries who have imposed a number of sanctions on it. Moscow has also responded with a number of counteractions, which have now amounted to sort of an impasse, as not only tried to halt trade at the global level, but has also sent prices soaring. So it's a massive problem. We're seeing inflation in the US reaching unprecedented levels as well. Inflation only recently moderated to 8.3%. It was before now at over 9%, and then moderated to 8.5%.
And let's bring the conversation back home. In the month of July, Nigeria's inflation rate rose to 19.64%. But according to the MBS, for the month of August, just a few days ago, the country's inflation rate surged to 20.52%, the highest since September 2005. What does this translate to?
Unemployment rate, last available data was in Q4 2020, and according to the National Bureau of Statistics, it came in at 33%. We believe, most analysts believe that it's way higher than that at this time. And, especially if you look at what, the manufacturers are doing in terms of downsizing, you want to imagine that many people would have lost their jobs over the period. And so, in a way, we're also looking at this inflation affecting, workers. Again, those who, retain their jobs would have to cope with a diminished purchasing power, right? So if you haven't had a pay rise over that period between July 2021 and July 2022, it means in real terms, your pay, your take-home pay is actually about 19.64% less than what it says on the face of it. So, it's raining on every roof, really, and it's affecting virtually every economic unit within the economy. And maybe I should also say this. Some analysts are of the view, right, that the inflation figure as presented by the National Bureau of Statistics is grossly underestimated. It's a gross underestimate, right? They are of the view that given the fact that the last time the basket, and by basket I'm looking at, we're looking at the aggregate of items that are surveyed in the monthly, CPI survey, right? Those items were constituted about 10 years ago, in 2009. The stock of habits of the average Nigerian household has since changed. We believe that, if these changes are reflected in the basket, inflation could actually go up another 5 to 10%. So we could be looking at an inflation rate that is between 20 and 30%. And so it's really
that of Ghana.
Yeah, Ghana is having to cope with an inflation rate of about 33%. Massive, but it's quite understandable. Apart from energy prices, Ghana is also having to cope with a balance of payment problem. They have a current account to GDP ratio of about minus 2.1%.
Well, I hate to jump in here, but financial institutions such as the World Bank, which says that Nigeria might have one of the highest inflation rates globally in 2022, with increasing prices diminishing the welfare of Nigerian households. And of course, just like the World Bank as well, the International Monetary Fund, IMF, is also insisting the rate of inflation in the country is expected to remain elevated in 2022. But just how problematic is this?
Yeah, it's obvious. I mean, the IMF has expressed its view several times about how inflation could be very, very detrimental to the Nigerian economy. As a matter of fact, they had posited that a lot of Nigerian households will need to be, in quote, bailed out by their family members in the diaspora. So the IMF actually also expected that inflation would affect Nigeria's real GDP output, real GDP growth for this year. So we had a real GDP outlook of about 3.4%, which in the IMF paradigm, because the IMF, according to the IMF, we grew by 3.6% last year. And so that means that we could see a moderation in real GDP growth this year. But at any rate, definitely inflation, when it begins to bite hard, will definitely affect households. We will see reorganization of our budgets. Households would definitely would reassign their spending, reallocate their spending to much more essential ends. And you see less of tourism, less of vacation, less of non-essential items, less of visiting restaurants, and businesses that run on such value propositions would have to take a hit.
So global geopolitical risks have soared since Russia's invasion of Ukraine. I mean, investors, market participants, and policymakers expect that the war will exert a drag on the global economy while pushing up inflation, with a sharp increase, of course, in uncertainty and risks of severe adverse outcomes. If the war continues in Ukraine, what do you fear the most in terms of the standard of living here in Nigeria?
I would say that in the global paradigm, right, energy costs, high energy costs contribute to about 40%. In the case of the US, contributes about 42% in the case of the EU. And so that shows that it's a very significant contributory factor to inflation in those two countries and consequently other economies. Right? So it's the same, really, to a large extent with emerging markets. But what we can be certain about is that monetary policy normalization, as well as rising crude oil and gas prices, would continue to have a depressing impact on the growth outlook for emerging markets. And of course, it also signals the possibility of a recession for the EU, especially. The EU is on the trellises, literally. Germany, not too long ago, recorded just a 0% growth, real GDP growth, meaning that they're just on the borderline. If we look at the PMI figures too, they kind of signal that borderline, not contraction and not really expansion. So things could just tip over any moment and we will see the EU in a recession. The import of that for emerging markets like Nigeria, or if you like a frontier market like Nigeria, is that it could have negative impacts on trade, because much of our trading partners like India, like China, like the US and the UK would have to moderate their demands from emerging markets like Nigeria. Now, in terms of capital flows, we saw a particular trend from recent capital imports data, and that was that Nigeria kind of relies so much on the UK, and that's been a pattern, right? Relies so much on the UK for capital flows. What happens if UK enters into a recession? I mean, you and I can predict. If the UK enters into a recession, we'll see something similar to what we saw in 2020, where capital imports, particularly of the form of FPI, would dip significantly. And so I feel that we can already see what is in the horizon. We can only hope, even though hope is not a method, that the global world powers like the US, the UK, and the EU don't go into a recession.
Mr. Abdulqudus, I mean, the Sri Lankan economic crisis is an ongoing crisis, of course, in the island state of Sri Lanka that started in 2019. That's, of course, the country's worst economic crisis since its independence in 1948. The same was also experienced in Venezuela in 2018. When inflation rates rose to above 900,000% and was expected to even reach 10,000 million percent by the end of 2019. Is that a possibility for Nigeria's economy, especially considering our debt profile at this time?
Well, so basically those two countries are faced with a balance of payment problem, and then they've accumulated so much debt. So if we were to look at those two, in a way, Nigeria is treading that path. It doesn't seem to be that bad at the moment. But if you imagine the fact that, if you take into consideration the fact that next year we're going to have to borrow in between 11.3 trillion naira and 12.4 trillion naira to, support our budgetary operations, it could push our debt profile to about 50 trillion naira. That's massive. And, that shows that Nigeria may actually be on the path to a debt crisis, right? But one very, very salient point we must not overlook, right, is that Nigeria still is able to leverage its oil, is able to, whatever little revenue we can make from crude oil is something we can still leverage. Well, it's been argued that our proven oil reserves are on the decline, right? It's also been argued that, maybe Nigeria cannot compete when it comes to the decarbonization. When we take into consideration the fact that there is a global agenda for decarbonization and energy transition, maybe oil is being phased out. But we believe that, oil and gas especially being a transition fuel, gas being also Africa's transition fuel and globally accepted transition fuel, provide Nigeria that opportunity. So I think that if we're able to handle the issue of oil theft and vandalism, if we're able to address some of the structural problems that have, over time prevented capital flows, especially of the form of FDI, we will be able to, if we're able to address those issues, I think we should avert that disaster.
As an economist, walk us through what you may consider as the ways forward, really, and perhaps recommendations. What should we be doing differently to grow our economy at this time?
Yes, so basically we should look at those four areas. We should look at, first of all, trying to leverage a disaster, right? So there's a global crisis. Nigeria can actually leverage this crisis. Crude oil prices have been rising. Nigeria's oil revenue has been tanking, and that's quite counterintuitive. Performance of crude oil between January and April was only about 39%. Despite a rally in crude oil prices, despite crude oil prices rising to over $100, Nigeria can leverage gas. Nigeria can enter into deals. We're beginning to do a little bit of that, but I think if we were to do that at a broader scale, we'll be able to take advantage of the crisis. That's one. Number two, we need to address the issue of these legacy structural bottlenecks. Our ports are very inefficient. It takes over 20 days to clear a cargo in a Nigerian port. It takes 3 days to do so in Lome. It takes fewer days to do so in other parts of Nigeria. Has the highest dwell time in this West Africa subcontinent, right? So it's a disincentive for investors. They don't want to come around there and spend so much time and have to incur demurrage again. So that's on the other hand, we need to address our issues of electricity and transport infrastructure to address, so much inflation that arises from all these inefficiencies. That's two. Number three, I think we need to also address the issue of money supply. So we've seen ways and means advances by the CBN to the federal government exceed, the CBN Act requirement. And so we need to moderate that. We need to moderate money supply and see how we can be in tandem with the growth of the real sector to reduce inflation. Then finally, we need to address our FX problems. We seem not to be getting our acts right in terms of FX. We need to get our FX policy right. Managing from the demand side isn't enough. We have a not eligible or non-eligible for FX list, which I think may also have been, contributing to some of these inflationary worries. That has to be reviewed. I think again that we need to work on trying to increase capital importation, especially by narrowing the gaps between the two markets, reducing the parallel premium. Parallel premium is massive. The differential, FX differential has typically been a major determinant, even more determinant than interest rate differentials in, trying to encourage or disincentivize investment from abroad. So I think all of those would help us achieve, liquidity within the FX market, and that accounts for about 70% of inflation in Nigeria. So it's very, very pivotal to nipping this inflationary crisis in the bud.
Well, it's a fine place to anchor our conversation with you. Senior economist at ProShare, Mr. Abdulqudus Isiaka, thank you indeed for your time on the program.
Thank you for having me.